Hello, all investors. Welcome to Smart Investing with Philippe. We go straight to what we're going to talk about today because there is a lot of information I want to tell you today. And let's go through the agenda of today. So I'm going to talk about the larger decline typically result in bigger recovery over 3 to 5 years. So we've seen quite a sharp decline, especially in IWM, in the QQQ, and also in the Max 7. And we are going to see what usually this sharp decline deliver as return in the next following years, and why it's important to buy during this sharp decline, because you increase your probability to win money. So what you're going to see also is the S&P 500 chart. We're going to see the recent sell-off and the market trend on the S&P, especially in relation to the VIX. And what is important also to look at the unusual VIX behaviors, the potential signal of market bottom, and the opportunity that the VIX can show you as a key indicators to start to enter the market and probably to play the rebound. And there's always been a strong indicator, and we're going to see it with a chart. You're going to see it with your own eye. So what we're going to say is that the strategy is to buy near the bottom, not to try to time it perfectly. Nobody can try perfectly the bottom of the market. But if you said last Friday was the bottom of the market and then at the end is Monday after the flush of Monday, is only one day difference. And if from Monday it starts to recover, which it seems to be the case, today also the market is positive, then it's not that we made a bad call saying the Friday was the bottom is a bad call. It's very impossible to tell exactly when is the bottom and the exact date, but it's just an indication of where is the bottom. Buying near the bottom is the objective, not at the perfect bottom. So we're going to see that the key support level for the S&P 500 is 5565, and we're going to see why the option market is telling us that this support level is 5565, and why this is important to look at the option market to have an idea of what is the sentiment after the flush of what the market participants are using to take bets on the option market. So what you're going to see also is the inflation data, and what is important to see that the inflation data is decreasing, and what impact this inflation data is going to have on the expected rate cut this year, and what this expected rate cut will have as an impact on high growth stocks. What you're going to see also is the Algo funds, what the Algo funds have done. The algorithm funds are the fund that automatically sell and buy stocks or indices according to the trend that they see in the market. So you're going to see that they have sold about 60 billions of S&P since February, and that it's probably a good sign that they are now net short on the S&P 500, and that's an indication that they must reverse this net short position if they want to really not take too much risk on the short bias of the S&P 500. What we're going to do also is to explain why you should focus on low risk trade for now and not on individual stocks. So if you want to focus on low risk trade, focus on the indices like S&P 500 on the QQQ or any other indexes that is more broad based. It's always recovered, as opposed to high risky stock like PLTR SOFI or even Tesla. These are very risky high growth name, with extremely high volatility. So this is not the focus I want you to take right now in this market uncertainty. So let's go jump into it. Please subscribe and press the like button. This will help the channel to get a broader audience and actually to get more investors get this insight of the market and to learn along the way with me and to make money along the way with me. That's important. I'm not selling anything. I'm not selling any training or coaching or whatsoever product on my channel. I just want to teach you and to help you make money on this market. So first of all, let's look at the larger decline usually leads to higher return the following years. And that's actually a table that shows you clearly the US stock return after declining of 10% or more, which actually what happened over the last correction. You can see that each time there is a decline of minus 56, minus 14, minus 10, minus 19, minus 33%, minus 25, minus 10, then each time that these decline actually happened the following years, on 1 year, 3 years, and 5 years, the return has been quite staggering. I mean, if you look, for example, the decline of minus 10% in 2018, the following years you get an 11% return, but over 3 years you get a 55.7% return, and over 5 years you have 59.2% return. So if you look more extreme move like in 2009, with a decline of minus 60% more or less, the following years you have 67% increase, and over the next 3 years you have 100% increase, or 5 years about 200% decrease. And if you look at the COVID crisis, then you had a decline of about 34%, and the next year you had an increase of 74%, and over 3 years 76%, and over 5 years 150%. Do you know? So on the last decline, the S&P in 2022, the S&P 500 just lost by 25%, and over 1 year, the next year, then the following years, you get an increase of 21%. So you see, and if you look at that was for 2023, but if you look over the 2 years, then it's even more, it's even close to 50%, because 2023 was about 22%, and 2024 was still about 22-23%. So you see, every time there is a sharp decline in the market, this is an opportunity for you to make money. So you shouldn't panic. You should take it as a very clear indication this is time for you to buy, or at least to DCA your position if you are still invested in the stock market. But you shouldn't at all sell. Selling during the sharp declines is probably the most biggest mistake that investors do, and especially people who have no experience at all in the market. So stop doing that if you want to make money. That's probably the biggest lesson I want to tell you today. One chart that I wanted to show you as well is the relationship between the sell-off of the S&P 500 and the level of the VIX. The VIX has been shown here below in red. Is the level of the VIX over time. You have the chart of the S&P 500 that you see clearly on the top pane. I mean, let's make it a bit bigger. Probably this one a bit bigger, so you get a better indication. Let me hold on 1 second. Okay, what you can see is there is a clear relationship between the VIX level, at least as an indicator of bottoming of the market, and the S&P 500. I mean, I can show you many instances where the VIX was at a high level. Well, actually, there were a peak in the VIX, and it's exactly at the same time that the market started to bottom. I mean, we can go back to 2023, even more than that. I mean, each time you see, let's take a few examples, you see. Okay, so the relationship between the VIX and the S&P 500 is obvious to me. I mean, every time you see that the market, the VIX has actually increased sharply and actually trying to reach certain level, then this is a sign that the equity market, at least on the indices level, is actually bottoming. I mean, you can see in 2023 you had the highest level for the VIX at around 33, and then you see it's exactly at the same time that the market just bottomed and started to recover. You can see also back in August 2024, for the reversal of the carry trade of the Japanese yen, you can see that was also a clear sign that the market bottomed at the time. You know, look at, if I zoom it, you can see a very sharp indication that this is the bottom of the market. Again, sorry, if we go back again in October 2023, which was also the time that the market was extremely volatile, and then you had a sharp decrease on the S&P 500 of about 10-11%, about the same level as now. And then you can see that the VIX actually was historically having a peak and the highest around the last few months, and that peak of the VIX is actually spot on the bottom of the S&P 500, at least for that small correction, or that correction of about 10%. And then from that bottom and correction of 10%, you see the huge rally that followed. I mean, don't underestimate the VIX level and the anomalies into the VIX level. And I mean, anomalies is like when it's extremely high or abnormally high. each time that coincides with the bottom of that small correction or that pullback of the market. That doesn't mean it's a bottom forever. It's just that it's the bottom of the movement that you are actually experiencing. So the likelihood that there is a rebound when the VIX is peaking is extremely high. That doesn't mean it's always the case. Like for everything in finance, it's not an exact science. But look at the chart. This is very obvious to me. So what we can learn from the VIX level and the S&P 500 is that now we have to try to buy near the bottom, not at exactly the bottom. Nobody can time exactly the bottom. And even though the VIX is peaking around right now, it doesn't mean that it can go even higher to reach maybe 40 or 32 or whatever. But right now we know that historically it's really high, and it's very unusual for the VIX to go to that level. And there is a good chance that the VIX can show us the bottom is near. And when the bottom is near, we should just start to reinvest in the index. Another way that we can see where the market is going right now, and that the market is bottoming in addition to the VIX or probably the RSI as well, then we can look at the option market. You see, this is a website called Bar Chart Premium, and I've subscribed to this website, and this is where I got all the data for my trading on the option. This is one of the best website you can get on the option market. And what you can see on the option market, especially for the S&P 500, you can see the following chart, and you can see the following trades and the volume and so on. So basically what you can see is that the put-call ratio for the S&P 500 over time, and you can see if the market is bullish or bearish depending on whether you have more put in the market or call in the market. And then you can also see the ratio and the evolution of that ratio. Usually when you see a lot more puts in the market, or a lot of people buying puts in the market, that means we are very near the bottom. Especially when the VIX is extremely high. People are buying a lot of very expensive protection for their portfolio. And usually this is a sign that the market has protection from the downside. I mean, this is counterintuitive, because you would think that if a lot of people are buying puts, that means the market will go down. Actually, that's the opposite, and I will show you why. Because you have to look at from a market participant standpoint. If you buy a lot of puts, if the whole market buy puts, it's almost impossible that the market, unless on an exceptional basis, go much lower than the maximum pain of the market for these puts. And I will show you on the charts that we can see and identify exactly where is the maximum pain. The maximum pain is basically, and let me show you. You see the maximum pain is probably near right now. You see the maximum pain on this chart, and you can see the volume on this side on puts and the volume of this side of call. The maximum pain is the position in the chart where, if the market stays, this is the maximum pay for option holders. So basically all the market makers, all the participants in the option market will make sure that the index, at least for the maturity that I've selected for the 14th of March, that's until next Friday, they will try to leave it in that specific level. That means that they're not going to be exercised for this and for this. That means all these people are going to lose money, and all these people are going to lose money. So you see, there is a strong incentive for market participants and institutional to stay at that level and not go lower or higher. You see? And if you look at for the end of March, what will be the maximum pain? Let's have a look. You see the maximum pain is more or less 575, and the current price is about 558. So you see the maximum pain is a bit higher than what we have today. That the market has an incentive to rally a bit from the low level that we see today, if you want to have all these option buyers not to exercise their puts. But if they exercise their put, there will be a lot of buyers anyway to buy at these put levels. So you see, this is a natural protection for the market. So the option market is telling you that This is also close to the bottom. So on top of the VIX and the RSI and history, then also the option market is telling you, at least for the shorter term and the medium term, the market is actually bottoming. And if you look now, let's see if we want to see by the end of May. Maximum pain is 576. 576, you see, is much higher than what we have today. So there is a natural bias. There is a natural bias for the market to go and increase for maximum pain for the market participant who bought the puts. So what also we can see is the open interest by strike. You can see the call open interest in blue and the put open interest in yellow. You can see that for example, for expiration of end of May, and I can do it month by month, so week by week expiration. But just to explain to you that what is so powerful in this chart is that it shows you that the biggest open interest by strike, and the strike is about 565, 562, 564. The biggest interest for puts is about that level. The market has not bought at all calls so far because the volume for calls is extremely low, and that's a sign of bullishness. The more people are buying put, the more bullish it is. And this is counterintuitive, but this is the reality. And what you have in see also is the chart of what is the maximum pain according to all the expiration of the option market up to 27, you know. And you can see the maximum pain, the last price is 558, and you can see almost all the maximum pain is above the 560 that we have today. So that means that overall the market expect the price to be much higher or higher than the price of today up to 2027. So you see, there's only for an expiry of 26th of March, which the end of this month, we can see the maximum pain is lower. But otherwise, the rest is much higher than the current level. Okay, you can see the put-call ratio and the volume of the put and the call in the market, at least for the last few days. You can see that the volume of the puts is much higher than the volume of calls, which put the put-call ratio, volume ratio on 1.15. And you can see that put open interest total is about 12 million. And the call is about 7 million, which actually show that the market is extremely bearish, which is a bullish signal. You see, you have to take it the other way. The more the market sentiment is bearish, the more this is an indication that the market is bottoming. So that means it's a bullish signal to enter the market and to benefit from or a technical rebound, a meaningful technical rebound, or a long-term rebound and continue of the bull market cycle. Okay, now if we look at the inflation number today that was released, we can see that the inflation has been quite good. I mean, much lower than expected. You can see core inflation rate month over month is 0.2 as opposed to 0.3 forecast, and the prior number was 0.4. Core inflation rate is 3.1% as a forecast of 3.2, and the prior number was 3.3. You can see that inflation rate month over month is 0.2%. with a forecast of 0.3%, and the prior inflation rate month over month was 0.5%, and inflation rate year over year is 2.8% as a forecast of 2.9%, and prior is 3%. You see clearly that the inflation number is going down, and it's going actually to the right direction. That means that the fear that the the tariff is going to have a very big impact on the price and inflation number is not yet showing in the number. So all this fear about tariff and recession and all these things is not showing up at all in the number so far. So what we can see also is because the inflation rate is going down, that means it gives more room for the Fed to decrease rate. Because if inflation was actually very, very hot, there is no room for the Fed to increase rate. So now that the inflation number has come a little bit lower than expected, then there is a higher chance that the Fed is going to cut rate. Let's have a look at where we can find the statistics on the probability of the Fed to cut rate over the coming meetings, Fed meetings. You should have a link between all these different data, because lower expectation mean probability of rate cut is higher. Probability of rate cut higher means the growth stock has some fuel to rally, because growth stock, they love decrease rate and lower rate because it's discounted cash flow. If you discount your cash flow by a lower rate, that means your value go up. I mean, it's pure mathematics. So let's have a look at the probability of the Fed rate cut. I mean, this is a website that everybody is using. It's called FedWatch from CME Group. You can also go to that website. You're going to have all the information that I'm showing you right now. And we are going to look at what is the probability that the Fed is going to cut rate on the different meetings that they have planned for this year. So you can see, for example, for March, as per the latest Powell speech, there is a very low probability that the Fed is going to decrease rate. I mean, actually, you see only 1%. There is a 1% probability. The market is pricing that the rate will be lowered by 25 basis points. But if you go further, if you go further down to June, for example, you can see the probability of one rate cut, 2 rate cuts is actually much higher, because you have about 56 and 21. That's about 77% of a 2 rate cut and 56% of 1 rate cut. You can see, and you can see also the number below the evolution of the probability. For example, in December, you have a clear idea that what the market is expecting as a rate cut. But if people are saying there will be no cut this year, and this is impossible because inflation is going to go high, or the economic the tariff is going to cause an increase in inflation, and it's going to be difficult for the Fed to decrease rate, and so on and so on. So I think what they are just doing is talking, because the numbers from the the Fed watch and the probability of the market for a rate cut is actually extremely high. They are actually pricing 1, 2, 3, 4, 5, even up to 6 rate cut this year. This is actually my point. If you expect rate cut and massive rate cut like 1, 2, or 3 or 4 rate cut, then you should be bullish for growth stock, because growth stock, the rate cut is the fuel for them, except if there is a recession. But if there is no recession, you expect the rate to go down. That means the growth stock are going to go up. It's just like this. It's just the way it works. Okay, what I wanted to show you as well is what the CTA fund is more like Algo funds and all the momentum funds and all these macro funds, that are technically driven and mathematically driven on the algorithm. And you can see that over the February and March, they have sold more than $60 billion of the S&P 500, and now they are net negative on their funds. So basically, they are net short on the S&P 500, which actually show that if after a huge sell of this magnitude of 60 billion, you can see the chart has been pretty neutral. For the S&P 500, they have stayed around 0, and then suddenly, bang, they are like minus 60 billions on the balance sheet. So they cannot sustain such a short position or net short position on the S&P 500, especially after a sharp decline like this. The do is probably reverse that trade. So that's also a key indication and an indication that the market will recover in the next few days or few weeks. If that was not enough from the other indication that we were explaining in this video. So basically, what I want to tell you, and we are going to conclude on that, is that after all that we have been explaining right now, and all the indicators that really show that we are starting to approach the bottom of this correction, and what will be the right strategy for people to take advantage of this correction. And again, right now, because there are still a lot of uncertainty and there is no guarantee at all that the market will not continue to decline, because all are just strong indicators, but it's not a guarantee. And even if the market rebound, because it's an indication for rebound, that doesn't mean that there cannot be a technical rebound and then after that another leg down in the market. But that's why you need to focus on low risk strategies. And low risk strategies so far is being invested in broad market indices like the S&P 500 or the Nasdaq 100. So because these are long-term strategies that on indices that tend to recover and grow over time. These are positive drift, positive bias instruments. Over the long term, the S&P 500 always recover. Over the long term, the QQQ always recover. So if you invest in those trades and then let's say that you have no luck, the market goes down another 10%. If you hold these 10%, you're gonna recover them. Always. That has never been the case. You have not recovered. I can show you 100 years of historic data. You cannot show me one time you didn't recover at some point. So what I'm going to say as well is that if you are risk averse, you are not familiar with the individual stocks you are buying, especially that if you are a momentum follower or you are just following what the key other YouTubers are talking in the market and so on. So what I'm going to tell you is to focus on indices and not individual stocks, especially on the high risk momentum stocks. The names like PLTR, SOFI, Mara, or MicroStrategy, or even Tesla. I can give you tens of, 20 names, 30 names of all these high growth stocks and high beta stocks, especially the retail names that all the retailers are just following on YouTube. So don't do this type of strategy, otherwise it's a losing strategy. So that's it for today's video. I hope that you have appreciated the work that I have done to show you the key indicators that we are near a bottom, or we are actually already bottom, and in the coming days and the coming weeks the market will recover. Whether that recovery is short-lived, this we don't know yet. But playing the rebound is also a good strategy. Also DCAing is also a very good strategy. History has shown us that if you buy after sharp decline, you are actually a winner over the 1, 3, and 5 years time period. So again, thanks so much for watching this video, and please subscribe, push the like button, and leave a comment. This will help me to grow this channel. Thank you. Take care. Bye.